What if one resignation gave a sitting U.S. president the power to quietly reshape global finance? Not with a new law, not with a press conference, but with a single appointment to the most powerful central bank on earth. This week, it happened. Federal Reserve Governor Adriana Kugler resigned. And that gives President Trump a rare opening. Most people won't notice. But if you understand how the Fed really works, you'll see why this moment could change everything. Because the story of interest rates, inflation, and even market stability doesn't start with Wall Street. It starts inside a room, where 12 people vote, but only 7 always matter. The Federal Reserve was created in 1913 after a series of banking panics. Its job? Keep the economy stable. But unlike other central banks, the Fed isn't just about inflation. It has a dual mandate: price stability and maximum employment. That makes it unique and powerful, because every decision the Fed makes to hike, cut, or hold rates affects everything from mortgage costs to stock valuations. And who makes those decisions? Let's break it down. The Fed is made up of 3 main parts. The Board of Governors, 7 members based in Washington. They're nominated by the President, confirmed by the Senate, and serve 14-year terms. Then there are 12 regional Federal Reserve banks, from New York to San Francisco. Each is run independently with its own president. And finally, there's the FOMC, the Federal Open Market Committee. This is the group that votes on interest rates. It includes all 7 governors, the New York Fed president, a permanent voter, and 4 rotating regional presidents. So 12 votes total. But here's the key: the 7 governors, including the chair, always vote. And that's where the real power lies. Regional presidents rotate. Governors don't. And that gives any U.S. president a chance to shape monetary policy, long before most people realize it. Each time a seat opens, the president can nominate someone who shares their vision for rates, inflation, or employment. And once confirmed, that person gets a vote at every single Fed meeting for years. This isn't just about economics, it's strategy. And right now, President Trump just got a major opportunity. On August 1st, Governor Adriana Kugler submitted her resignation. She'll officially step down August 8th, months before her term was set to expire. Kugler was the first Latina on the Fed's board, a labor economist, and a key vote aligned with the current leadership. Now, that seat is empty, and President Trump gets to fill it. That means, as of today, he can nominate someone aligned with his push for aggressive rate cuts, a policy he's openly advocated for on social media. In fact, just weeks ago, Trump called Jerome Powell, the current Fed chair, a stubborn moron and demanded his resignation. And while Trump can't legally fire Powell before his term ends in May 2026, this new vacancy gives him something just as powerful: voting leverage inside the FOMC. Trump may fill 1 seat now, but there could be more. By mid-2026, at least 2 more board seats could open up, and Powell's own term as chair ends in May. That means the balance of the FOMC could swing fast. With enough appointments, Trump could tilt the Fed toward faster rate cuts, looser financial conditions, and possibly even a rethinking of the inflation target. That would have huge implications for markets. Bond yields could fall faster, the dollar might weaken, asset prices could surge in a liquidity-driven rally. But here's where it gets tricky. The latest jobs data is starting to crack. Hiring is slowing, quit rates are falling, yet inflation is still above the Fed's target. So the question isn't just, will the Fed cut? It's, can we afford to? Some believe the inflation engine has cooled and that we can safely lower rates. Others warn, we've seen this movie before. Ease too soon and inflation could roar back. And with Trump pushing for faster cuts, the margin for error just got thinner. If you want to understand why this moment matters, not just for the Fed, but for the future of money itself, check out our video. Ray Dalio's Real Warning: The US dollar is running out of time. It explains how debt, inflation, and policy choices are colliding, and what that means for investors around the world. Link in the description. The Fed isn't supposed to be political, but it's always been shaped by politics. And today, 1 seat, just 1 resignation, may quietly set off a shift that rewrites how the US manages inflation, debt, and global financial power. Jobs are softening. Inflation isn't done. Cut too early, and you risk another spike. Wait too long, and the economy could stall. And with Trump reshaping the board, those calls won't just be economic. They'll be political, they'll be personal, and they'll shape how every dollar and every asset performs in the years to come. If you found this helpful, hit like so more people see it. And subscribe for more global financial stories the headlines miss. This is Global Notes by JP, where we connect the macro dots others overlook. You're not just subscribing to a channel, you're staying one step ahead of a system in motion. The Fed's structure hasn't changed, but its balance just did.